There we go.
Perfect.
So as I mentioned, we are going to do a quick update, Kevin. I'm looking at what happened. We'll go through what we believe is on the horizon, and then we'll make sure that's brief. So Adam's got lots of time to talk about estate planning, lots of time to provide those tax tips, and then we'll be taking questions as we go. And a reminder for the questions, if you're on Facebook or whether you're on YouTube, all you have to do is type it into the comment section. We can see those, and we'll tackle them throughout the presentation. There is some time allotted at the end of the presentation, but don't feel obliged to wait until the end. You can certainly tackle those whenever we have an opportunity. But before we get into the market update, we'll do a quick review, starting with the firm involved.
Yeah, Canaccord Genuity Global Wealth Management. We are the largest independent wealth management company in Canada. We have entrusted assets of around 73 million globally. We have offices from the West Coast straight through to the East Coast. We're also in the UK and Europe, as well as Australia. And one of the important things to remember about our firm is we are under the CIPF, or the Canadian Investors Protection Fund. That is the insurance that we have on the accounts, up to $1 million per account. It is the same insurance that the banks use, so we feel that we provide the same sort of a service there with that regard to being able to help people out.
Absolutely. So you have information there on Canaccord, a quick review of the team. And we know we go through this every time, but we believe it's important. You can see all the full-time members there on the screen. In addition to those 5 folks, there are many people part-time that also help out. And as a team, our promise to each and every client, it is commitment, clarity, and confidence. For us, commitment, that's all about communication. You have to hear from us. Lots of changes in the financial world, lots of changes in your lives. So we need to make sure those lines of communication are open. If we do our job there, it should lead to clarity. We want full transparency when it comes to the objectives, when it comes to the fees, the rates of return, all the cards on the table, high level of commitment, high level of clarity. The end result is confidence. Confidence in our team, in our process, most importantly, some peace of mind and confidence with your financial plan. I did mention the process, a little quirky, we call it financial architecture. The analogy is if you're going to be building a home. It'd be tough if you focus just on one area. You need to make sure all the pieces of that house are taken care of, the foundation, the frame, as well as the interior. Same thing in the financial world. You have to look at all the pieces, and there's a bit of a sequence to it. You want to start with that foundation. In finance, that foundation is going to be your estate. It'll be your life insurance needs. We'll talk about that tonight. After that foundation, you start talking about the frame. That's retirement planning, that's tax planning, and what we do there will influence the interior, which are the investments. So we do that for each and every client. We'll talk about a few of those pieces tonight, so please keep that in mind throughout the presentation. Kevin and I will go over a quick market update, then we'll hand things over to Adam for the estate planning. And Kevin, lots happened in 2020 and early 2021. Why don't you walk us through it?
Yeah, 2020 was definitely an anomaly year. I mean, it is a once-in-a-lifetime, hopefully, pandemic scenario that we ever see. We saw the fastest 40% drop in market history in roughly 3 weeks, and we've seen a really nice rebound from there. So basically, a lot of the times what you'll get is the descriptions of how did this happen. So we've had either a V-shaped recovery, which is straight down and straight up, a U-shaped recovery, which goes down quickly, holds at the bottom for a while, and then starts to move. But what we've experienced has been something known as a K-shaped recovery. We've had some things do very well on the way back. We've had others that haven't done much at all. So the growth stocks that we have, basically we want to talk about, are sort of captured by that technology sector we're looking at. The value side would be more the energy sector. So as we saw when we were locked down, when we couldn't go out of the house, when everything was there, we're using technology, Zoom, Amazon, we're on our phones. But technology did very well, up roughly 54% for the year. Energy on the other side didn't do quite as well at all. Nobody was going anywhere. There wasn't much in the way of travel, so you didn't need that. Manufacturing didn't need it the same. So we see that they were down roughly 37% for the year. Now, 2 events happened in November that started to switch this around. One was we had a U.S. election and a new administration was put into the office. And 2, and more importantly, Pfizer and Moderna came out with their vaccines, and they showed 90 to 95% efficiency. With that, what we saw was all of a sudden the markets were going to start to open. So what we saw was that the prongs of the case switched completely. Now value stocks are moving and growth stocks are not. So captured from October moving forward here, we see that energy has been moving dramatically up. And we've seen that in a lot of those value stocks because the world's supposed to be opening. Vaccines will come out, will do much better. Whereas technology, though it hasn't fallen off the face of the earth, has slowed completely because if we're going to be outside, we're not using as much of this going forward. So all of these things have been what we've seen over the last year and up to the end of the first quarter now. Where do we see ourselves going from here, Clint?
We think a continuation of that theme, Kevin. Still looking at the prongs of the K that have shifted. Now looking at the economic reopening. That in our opinion, is the big event. And of course, we need vaccines to get there. And we think when the economy does reopen, you get a burst of activity. And the size of that economic boost will be dependent on the stimulus. And to give you an idea of just how big that stimulus is, we can go back to the last recession, 2008, 2009. I still remember in 2008 when they're going to Congress asking for $700 billion in the U.S., and there was big pushback. That was such a big number. No way they're going to get $700 billion. Of course, they did eventually get that number. If you fast forward to today, we had 2 stimulus packages in the U.S. last year, a third one early this year. You tally them up, you're looking at $5 trillion, a significant sum. And the U.S. is not alone. Canada's done the same thing. Europe has done the same thing. Many Asian countries have done the same thing. So a significant level of stimulus. And we think when we open up, you'll see a big boost of activity because of that. And certain sectors will benefit more than others. So the cyclical, economic sensitive sectors, think restaurants, think people traveling. So they're going in their vehicles, they're traveling, they're taking planes, going to hotels. All of that will get a benefit. Some parts of the world will be more favored than others. Europe, for example, lots of value companies, lots of financial companies, they could see a boost. Some emerging markets are more commodity heavy. They could also see a boost. And to give you an idea of the overall economic lift that we're expecting, many economists think Canada's GDP could grow by 5, maybe 6% this year. And for the US, most folks are expecting 7, maybe 8%. Compare that to the last recession where we barely got 3% GDP growth. We're now looking 2, maybe 3 times that coming out of this recession. So some pretty big numbers. Kevin, I think most folks, when they hear those big economic numbers, are thinking, oh, that could lead to inflation, that could lead to a rise in rates. What is the story there?
Yeah, basically that's a perfect description of what's going on. As we're getting that market to come open, as we're looking at that possibly 5, 6, 8% gain, now we have to worry about an economy that may be overheating as we open up. So the way to counteract that is through rising interest rates. And we've seen with that possibility that inflation breaks that 2.5% barrier and starts to go, you want to cool it down. And the way to do it is to raise rates so you take money out of the economy. People will look at other things. So what we've seen here on the chart in front of us is the red line is the 10-year Government of Canada bond. The blue line is the U.S. Government of Canada, or the U.S. government bond. And as we've seen, these things have basically been twixt together for a long time. And we've seen over the last little while, it moved from roughly 1.2, 1.3, all the way up to that 1.7, 1.8 range. It'll probably trade between 1.7 and 2 over the course of the next year, but it's not a huge difference that we have to worry about yet. If it starts creeping much higher than that, it may be a big scenario, but again, rising interest rates are going to keep the economy on track in growth and not allow that inflation to go too far, too fast.
That's right. We'll take a quick look at commodities. We'll start here with oil. We'll look at copper in a second. This is all part of that same theme, that economic reopening theme. I'll pull the chart up here for oil for the WTI, the West Texas Intermediate. And you can see the shaded zones. Those are prior recessions and the recession we're in now. And you can see we get a rally typically coming out of those recessions. There are some similarities to prior recessions, never a perfect comparison, but you do have some similarities. In that 03 to 07 period, you had larger economic growth. You did have some inflation. You can see oil prices had a pretty big run up. And then coming out of the 08-09 period, you had slower economic growth. Initially, you had higher interest rates and higher yields, but that changed and they went lower. And then this time around, we'll probably have more economic growth, a little bit of inflation. But the big piece here is we'll get that gargantuan amount of stimulus. We think the rally coming out of this recession can be even larger than what we've seen out of prior recessions. And it's the same story for copper. We'll flip the slide here. You can see the copper prices. And again, coming out of those recessions, you tend to see a pretty big rise. Often copper leads the economy. It can be a bit of an indicator. And we think with all the stimulus, the economy reopening, there could be some more room to run in copper prices as well. But Kevin, the market, it doesn't really care what we think. We believe this is a good thesis, but we always have to keep in mind some data that might make us shift our thesis. What should we be looking at?
Yeah, no, the market's rarely considered what we think is a basis going forward, but we might as well take a look at this. Things that could change, and we do believe that the market will continue to move up through 2021, but stuff along the lines of mini manias. If we go back and we look at the GameStop scenario and how that affected the market for a little bit, and hedge funds. Also, the recent one has been Archegos. That's been another one that's had Viacom and Discovery as stocks that have been bounced around there. So that's something to be concerned with. A strong US dollar. The stronger the US dollar gets, it's going to affect materials. It's going to affect energy. It's going to affect the way manufacturing goes. That could put a damper on the economy. Higher than expected inflation. That's the thing we're worried about right now with rising rates. If we're getting inflation at that 3, 4, 5%, then rates have to go up, and we have to worry about how that's going to affect the economy going forward. And finally, if we look at it, the slow vaccine rollout. In Europe, in the US, we've seen fairly significant rollout that's gone on, 30, 40% of the population. Canada's more in that 10, 20% range. So we're slower there. If we get a third or a fourth or a fifth wave, it could have an effect. Or if there's more variants that come out that the vaccine doesn't help out, it will have an effect on how the market opens and what we are going to see going forward with stocks, as well as bonds and anything else along that line.
Yeah, so leads to the question, what should we do? We do believe that economic reopening theme makes sense, and we do encourage folks to position for that. In addition to that, we still like our pension strategy, and that means more stability, a little more consistency. What I've pulled on the screen here is from CPP, the Canada Pension Plan. You can see their asset mix, and they have over $400 billion in there. They have a whole team that manages it, and they do have some in the public stock market, but they have lots of other pieces that the average investor typically does not have. You're thinking private equities, they have real estate, they have credit, they have absolute strategies, and that's what we'd encourage to add. So in addition to having some of that reopening theme positioned in your portfolio, we'd encourage us to add some of that private debt, some of that private equity, help reduce the risk, diversify the portfolio, smooth things out. An example is on the screen now. This would be an example of private debt. This would be the Antrim Balanced Mortgage Fund. They've been around in Canada for a number of decades. They're not in the stock market, so they don't get impacted by all that day-to-day volatility. You can see some of the rates of return at the bottom of the slide there, very consistent, very stable. Since inception, they have not had a single negative month, so very stable, very steady. So if you position yourself for the economic reopening, you add in a bit of private debt, a bit of private equity to lower the overall risk. We think that is an appropriate way to move forward. I know we did that quickly, so we wanted to leave lots of time for Adam, but were there any questions, anything we can tackle at the moment? Yeah, I'm not seeing too many come in, so we'll pull Adam in here. We'll let him get all set up, and we'll move on to go with our theme, our estate planning theme, and then we can tackle any of the tax-related questions. Adam, are you ready to go?
Just working on sharing my screen here.
I think you're all set up there by the looks of it.
Perfect. Excellent.
All right. Well, we'll hand things off to Adam. If you do have a question throughout the presentation, just type it into the comment box, and we'll make sure you get an answer.
Wonderful. Thanks, Clinton. So as Clinton and Kevin mentioned, or they didn't mention, but I am the wealth and estate planning specialist here on the team. So my job is to look after all the financial planning needs and strategies and tax minimization for our clients. We'll start off with a little disclaimer, keep the compliance folks happy. So just to recap, I'm not a lawyer, I'm not an accountant, I'm a certified financial planner by trade. I don't know your exact financial situation. We're going to cover a couple different strategies. Some of them may fit, some of them may not fit. When in doubt, certainly see us. We want to go through the financial planning process. That's certainly something we're big believers in. We want to work together to achieve whatever your financial goals are, and we want to make sure that we find the right strategies and solutions to suit your needs. So let's just kind of go through a little bit about me, my lovely photo up there, kind of how we work, how the financial planning process operates, some of the different things that we go through when we're looking at doing a comprehensive financial plan. But let's get into the important stuff, which is why we're all here, which is how to minimize taxation on your estate. So just by show of hands, virtually, how many of you, dislike paying too much in taxes? So, I mean, most people don't like paying a lot in taxes. I'm definitely one of them. That's probably the biggest question that I get asked with pretty much every financial plan is how can we minimize tax? So here's a couple of the ideas. So if you didn't get a chance to catch our last presentation when we talk about how to draw down a lot of the registered accounts in retirement time, that certainly covers a big chunk of it. But now we're looking long-term beyond that and how do we minimize taxes on the estate? So we're not going to go through everything on this list. Some of it we'll cover today. Number one, obviously, is having a financial plan. If you don't know what it looks like, if you don't want to know what the projections are, what the future estate tax liability might be, it's pretty hard to try to put together any strategies that are going to help accomplish that goal. When it comes to estate planning, review your beneficiaries, review your RSP, your TFSA, your life insurance, make sure it aligns with the will. We'll cover some of that. definitely take advantage of drawing down the RSPs, including with income splitting, using your tax brackets to your advantage. So some of these topics we did cover previously. Charitable giving, if that's something that's a priority for you, can be a great way to help offset taxes. For anybody who has a corporation, will there be surplus holdings inside the corporation, whether that's real estate, whether that's cash, investments that have built up? There is potential, even though the corporation doesn't die, shareholders do pass away, and the value attached to those shares is taxed at that point in time. There is potential of double taxation, even triple taxation when it comes to corporations at time of death. That's a much bigger topic, so we're not going to cover that one today, but if you do have that as a concern, by all means reach out to Clinton, Kevin, or myself. We'll make sure that we address your situation. Continue to maximize the TFSAs, and then we'll look at permanent life insurance strategies as well. A little bit on income splitting. So I have covered this topic, I feel like a number of times before, but just again, a recap. Certainly, while we have the advantage of two people on a couple in retirement time, we want to try to get as much out of those registered accounts as possible, take advantage of splitting that income between the two of you so that we can help minimize the tax as best as possible as a couple. So beneficiaries. So today we're not going to have the ability to go through every last detail about actual estate planning, making sure your wills, your power of attorneys, your healthcare directives are up to date. That's obviously a key component of a well-laid plan. But we also want to make sure that your beneficiaries are up to date. And of course, that they don't contradict your will. So how does a beneficiary work? Well, if you list a beneficiary on your registered account, so your RSP or your RIF or your TFSA, your life insurance, a segregated fund, you have the ability to direct who you want those funds to go to, and they bypass the will and go straight to those individuals, which means that they aren't subject to probate. There are pros and cons when it comes to that decision. We did cover a little bit of the products that you can designate a beneficiary on. A big one that we want to look at, especially for a couple, common law or married, is a successor annuitant or successor holder. So it's basically just a fancy beneficiary when it comes to specifically for your RIF for successor annuitant, which means it moves over to the surviving spouse exactly how it is. So it's a tax deferred rollover. So no tax when the first spouse passes away. And then they just continue to draw out the RIF payments. A successor holder is for tax-free savings accounts, which means that the tax-free savings account moves over to the surviving spouse as a tax-free savings account. So the spouse could technically have double the amount that a person is typically eligible for, while all keeping it inside that tax shelter, which helps again for overall tax efficiency. So if you do have a TFSA or a RIF, you want to make sure that those are set up to go to your spouse, ideally, if that matches your wishes. What happens if your will contradicts your beneficiary designation? Well, this certainly can open a big can of worms and can cause a lot of extra headaches and hassle for the estate down the road. Generally, it comes down to which one is most recently dated. So if I did my will 5 years ago, but then I assigned my beneficiary designation today, they'll typically look at my beneficiary designation as that was the one that was most recently completed. So it's all fine and dandy if everything lines up to the same person. But what happens if you list two different people and they're contradictory to each other? That can open, again, a whole can of worms and cause a lot of delays. I did have this a number of years ago from some accounts I inherited as an advisor. A daughter was listed as the beneficiary and a spouse was listed in the will as the beneficiary on a registered account. The beneficiary was most recently designated, which meant the RSP was entirely cashed out to the daughter instead of being a tax-free rollover to the spouse. And extra delays, extra court costs, and it was just a huge mess. Far easier to make sure everything properly aligns together. What are limitations on a beneficiary document? I'll cover that one quickly. It does get a little limited in trying to do, multi-generational giving or some of the what-if scenarios. It's pretty easy if it's just to one individual. But what happens, let's say I have two children, I want each of them to get 50-50 of my RSP as an example. If one of them predeceases me, their half doesn't go to their children, my grandchildren, it goes just to the survivor instead. So maybe I wanted 50% of that amount to stay in that one family unit for my deceased child versus going solely to the surviving child. So it is quite limited in some of the different possible scenarios that could come up. But sometimes it is easier just to list it all in the will. I may have not covered this recently, but if you're in Manitoba, Manitoba recently waived probate costs as of, I think it was November 2020. So there's not necessarily a lot of advantages of trying to entirely avoid the probate process because the costs have mostly disappeared from that. Well, let's look at some of the possible scenarios that could happen. So if I leave my RSP directly to two beneficiaries, so let's say there's a couple, they have $500,000 in an RSP when they pass away. They have two children, they want each of them to get half of the RSP. Easy enough. List both kids as a beneficiary. Each child gets a check for $250,000. Done deal. That avoids probate. It's fairly quick and easy to kind of get that accomplished. But that's, who's going to pay the tax bill is what it comes down to. So the estate gets the tax bill because it's as if you earned $500,000 on the last day that you're alive and get taxed accordingly. So based on that, the kids might have already spent the cash. If the estate doesn't have the money, who's going to pay the tax bill? Well, each of the beneficiaries is individually and jointly liable for the tax bill. So maybe child one went and bought a Ferrari on day one with the cash and the other one invested it. Well, only one of them has some money to put back in the estate to pay the tax bill. So there are some negative potential consequences that could arise.
Yeah, we have a couple of questions for you, Adam, so I'll jump in with the first one here. Pull it on the screen so you can see. It has to do with leaving beneficiaries. The question is under the impression my lawyer that I couldn't list my son as my receiver of my RIF. It had to go to my husband. I think there could be some confusion there about disposal rollover versus going to the next generation. Can you touch on that?
Yeah, it can really go to whoever you want. The only time it is very specific, if it's pension dollars, so if it's in a LIF or a LIRA, generally that has to go to the surviving spouse, and that's where it can get extra complicated if you list the wrong person, but typically that's where it has to go. Otherwise, there's the tax-free rollover. It does go to the spouse, and a not to tax-free rollover if it goes straight to the child.
Okay. And if you do have more questions, please type them in the comment box. We'll continue to tackle them. Otherwise, I'll hand it back to you, Adam, to continue the presentation.
All right, great question. Keep them coming. All right, so we covered some of the possibilities there with the beneficiary. As for estate goals, that's obviously a priority. We want to figure out what's important to you. So what kind of legacy do you want to leave behind? What does a legacy mean to you and your family? Who do you want to benefit from your estate? Perhaps it's your children, your grandchildren, a charity, your favorite financial planner, whichever the case, they're all good selections, but those are things that we want to kind of look at. What's your estate tax liability? Do you have maybe a rental portfolio, a cottage, RSPs that are left, capital gains? Is there any ways that we can try to manage that tax bill for you down the road? How does charitable giving factor into your long-term goals? Whether you're wanting to give consistently on an annual basis or a lump sum when you pass away, how can we make sure that gets accomplished and take advantage of some of the tax opportunities as well? And of course, how would you like to be remembered? There's no right answer. There's no wrong answer when it comes to this. I get people saying, I don't care. I'll spend it all. The kids get whatever they get. And some people say, I want to make sure that I leave $1 million to, Heart and Stroke Foundation or whatever the case happens to be. That's an important goal. So that's what we want to try to work towards accomplishing for them. So I get it. It's not a fun conversation to have. Nobody likes to talk about death and what happens, but it is important. And we want to try to, make sure that whatever's priority for you can be accomplished. Life insurance. So, elephant in the room. Who doesn't like talking about life insurance? Yeah, most people do not like talking about life insurance. I'm not going to lie. Mostly the only people that like talking about life insurance are the people that sell it. I understand it. Today, we're going to focus on some of the tax advantages that life insurance can bring. You've probably used life insurance, hopefully to protect your family, for your term insurance needs, for protecting the mortgage, you're replacing your income if something was to happen, covering business debt, a whole variety of different reasons. That's usually term insurance for most people. We want to look at for how life insurance plays into the estate planning. So estate planning is generally a long-term goal, something that we want to look at a permanent insurance solution for. and because it's going to be when you're older that it's going to come in. I see Kevin's joined us.
Yes, Adam, there's another question that we have. The question basically is, are the benefits to putting your children's names on our house and on our cottage as co-owners?
That's an entirely different conversation. There are certainly, I guess it depends as to what the reasons are behind doing it. I mean, most people in the past did that to try to get around probate, which you can get around probate because it generally falls to the survivor. It comes down to, okay, well, now your house, is it still considered your principal residence because now there's other people on title? When do taxes have to get paid? Are they paid immediately? Are they paid down the road? That asset is now exposed to the kids' creditors. So if the kids have financial challenges or have marital problems and they get division of family property, you could lose your property as well along the way because it is jointly owned. If you just add one child to the cottage instead of the 3 or 4 that maybe are going to get it in the will, it could be called, I'm trying to think of the legal term, I think it's a constructive trust or a resulting trust, one of those two, basically where it doesn't actually bypass the estate. The courts are going to come back saying, well, you didn't actually intend to leave this asset to this person. It has to go through the will anyways. So really you did a lot of that and just caused headaches for nothing. So there certainly can be logical times that it makes sense. I would just say have a conversation with us, have a conversation with your lawyer and see what makes sense, as long as you understand the risks involved with doing it. I feel like that was a really long answer to get to that question, but it's a complicated question.
Thanks.
Excellent. All right, so when it comes to permanent life insurance, there's certainly a variety of overwhelming options, as you can see on the screen. I don't even think this is all of the different possibilities. These are just some of the things we're looking at. So a variety of different products. So the idea is we're looking at a whole life, so something that's a permanent life insurance that's going to be around until you pass away. There's term to 100, universal life, participate in life insurance. We can pay it in a short time period. We can pay it over your lifetime. A variety of different ways we can structure it, all to meet your needs and the cash flow requirements and whatever goal we're trying to accomplish. So there's certainly not a one-size-fits-all approach when it comes to this. The key one is at the very top in the middle where it says tax exempt. So whole life insurance in Canada is exempt from income tax. So as long as it meets all the requirements, which generally all new policies that we issue do, it is tax exempt from all the growth. So any time that these policies grow in value, which I'll come up with, is 100% tax-free to the estate down the road. So it's a great way of minimizing tax bill and trying to maximize the estate. So a variety of different ways that we can try to bundle it to suit your needs. So what is participating in life insurance? So this is one that we often use as it has a bit of an investment component to it, and it's fairly, I'm going to say it's simple to understand, but yet it can be complicated. So PAR, so participate in whole life insurance. So the idea behind this is it grows the death benefit of the policy over time. And the insurance company tries to take a lot of that market risk out of the equation. So you see the crazy red line. So that's the ups and downs in the market cycle, which is part of the normal market cycle. But many people don't like that part of being invested in the market, but they want some decent rates of return. So you'll see, I think it's the yellow line on this one, is the insurance company kind of smoothing out the return. So they're going to pay a dividend into the policy, which helps grow the death benefit. And again, all of that growth is completely tax-free inside the policy. And that helps grow the value down the road for the estate without taking on that market risk. So most of these policies are paying somewhere between the 5 to 6.2% dividend scale as of today's date. They've never, ever missed a dividend payment for the most of these companies in the past 100, 150 years that they've been around and these policies have existed. It's a great way of using it as a diversification tool for fixed income, as it is consistently paying income. And of course, we do get many clients that say, well, I don't like what fixed income is paying today, and I want to do better, but I'm not willing to take on some of the market risk. We'll look at another one here. So this is again comparing how is the participating fund of this insurance policy, how is it been doing over history? So even in 2020, it grew almost at 10%. As we all know, 2020 was a bit of an odd year. GIC rates are kind of at their lowest point, 1.2 to 2%, maybe if you're lucky these days, for a GIC rate. And this policy is paying 6% fairly consistently. And it's a great way to kind of use it to replace some of that fixed income. And again, it's all tax-free. So we'll cover some of these as we do go on here. All right, great. We've talked a little bit about life insurance, but how can insurance help me with my tax problem? So let's look at a couple examples here. So these are examples that I come across very often with clients. So let's meet Joe and Mary Sample. They're both 65 years old. They have 2 children. They have a few scenarios of theirs that are of concern. So not necessarily that all 3 of these scenarios will apply at every single time, but one of them may apply in most cases. So first one, they have $500,000 of non-registered money. They really don't want to take on too much risk. They're pretty much in GICs right now, or very low risk fixed income. So they're not getting a lot of great return on that money currently, and they want to do better. And all that cash is basically going to go to the kids down the road. How can we try to maximize that for them? So that's one thing we're going to look at. Family cottage. We get a lot of people that have a family cottage, and it's quite important that they keep that in the family for generations to come. So we want to try to cover some of the tax liability that might be on there. And the last one we'll look at today is charitable donation. So in this case, Joe and Mary want to leave the charity $500,000. So how can we make sure that that gets accomplished along the way? So let's tackle some of these as they come up here. So insurance is an investment strategy. So I did mention this one a little bit before, using it as a way to kind of replace fixed income. When people think of insurance, again, they just think most of the time as to death benefit. It's leaving money for my surviving spouse. In this case, we're flipping the switch and saying, you don't need insurance to make sure your spouse is okay. This is using it as a tax tool to maximize the estate and generate some better returns. I see Clinton popped in, so I don't know if he wants to ask a question before I dive into this one.
Yeah, I'll ask a question here. So again, happy to tackle all the questions. This isn't specifically on the tax that you're talking about or the insurance as a way to help battle that tax. It's more on the principal residence exemption, but I'll pull it up here. It says, my mother sold her house about 15 years ago, and our accountant has claimed her cottage as the principal residence since then. Was that a prudent move, and will it help for inheritance purposes? So we don't have all the details of the situation, but maybe you can comment on the principal residence exemption, how it might apply in this case.
Sold her house 15 years ago, can't claim cottage as residence, and so I am assuming she's in the cottage right now, would be my guess.
That'd be my guess as well, yeah.
Okay. It comes down to how many years you've owned the property and how many years you've determined it was your principal residence. So it's basically like a time and usage test. So for simple math, let's say you owned it for 30 years and 14 years of that time it's been your principal residence. Well, they also have a +1 rule. So it's number of years +1. So 15 of those 30 years, you consider it your principal residence, which means 15 out of 30, 50%. Yes, nice simple math for a Thursday evening here. So 50% of the gain is taxable, and 50% of it falls under your principal residence exemption. So that's kind of the simple math. They'd have to go more into the details of that specific property, but by all means, give our office a shout, and I'm sure we'd love to have a conversation.
Yeah, and if there are more questions, I appreciate Adam's getting into the nitty-gritty of the tax side of it and a strategy to help battle the taxes there. But if you have anything in the estate planning topic or on the markets that Kevin and I talked about earlier, feel free to throw that in the comment section. We'll be happy to tackle those questions as well.
Excellent. So going on to the insurance versus the investment side. So what I did here is I ran it kind of side by side. So again, Joe and Mary, $500,000. They're earning very low safe rates of return. They don't want to take on too much risk, but they also don't like paying too much taxes every year. So let's say they're getting, a 2% GIC rate, which I think is a high GIC rate these days. Hard to imagine that's high. But of course, they got to pay tax on that every year as well. So they don't get to keep all that growth. So, after 25 years of that growing at the 2%, they're left with, just under $700,000 of value in that investment account to go to the estate. Hey, $700,000, that is a fantastic number. The kids would be more than happy to receive that amount, I'm sure. But can we do better? Can we save more on tax? So we say, well, let's take that $500,000 and let's shelter it inside a tax-exempt insurance policy. That's a participating policy that grows in value as tax-exempt. Well, now that value grows to over $1.3 million at age 90. So you've just generated nearly $600,000 more in wealth by not taking on any more risk. Plus, you saved about $91,000 in income tax during your lifetime just by doing that switch. So I don't know about you, but it certainly sounds like a really good deal to me. Again, I'm biased. I do sell the insurance. Not gonna lie. When it comes to how do the numbers actually compare just visually, so the green is the insurance. So right from day one, that's certainly where you get your best bang for your buck. If you both passed away in year one, you haven't paid a lot into the policy, so yes, you certainly get the best rate of return there. But if we average it out, and even at age 90, how does that rate of return compare? Well, the policy basically generated just a hair under 7% rate of return pre-tax kind of throughout that entire time period versus a 2%, probably a 1.3% after tax GIC. That is a substantial difference without taking on more risk. So you're sitting on, a bit of extra cash that is just kind of collecting some interest, and you're probably never going to use it during your lifetime. This can be a great way to shelter it, grow that wealth for the next generation, and save some taxes along the way. So certainly a good thing. Now, often I do get asked, well, okay, great, it's all wonderful, it's out of sight, out of mind, it's inside this insurance policy. Well, what happens if I need some of that cash along the way? Well, these policies generally have a cash value that we can access should you need some of the cash. Now, we're typically looking at this saying, what amount is truly extra cash that you're likely not going to need in your lifetime? Because this would probably be your very last pot of cash that you want to dip into, because it's completely tax exempt. So if we can not touch it, that's obviously the best case scenario. So that's a great way to treat it as an alternative style investment. Now we'll look at planning for the family cottage. So again, Joe and Mary have a family cottage at Falcon Lake. They really want it to stay in the family. They want their children to inherit it. They want their children not to have any additional financial burden from taking on this cottage, this family inheritance, the memories that they want them to inherit. Whoever has owned a cottage before, that they've gone up a fair amount in value over the recent years. So maybe today, if Joe and Mary were to pass away, they probably owe about $100,000 in capital gains tax. Well, property values seemingly just keep going up and up and up. So projected at age 90, they'll owe just a hair under $240,000 in income tax. Well, that is quite a large tax bill on that property. So what are some different ways that we can help mitigate that for them? All right, so for planning, so we can do a couple different things. Either, the estate has some additional cash to pay that tax bill. That's fine. We can liquidate an asset to pay the taxes. So maybe the kids are saying, well, we can't afford to pay that tax bill. So now we are forced to sell the family cottage just to pay the tax man, and then we walk away with the difference. Or the kids have to take out a mortgage to pay the taxes. Then of course there's an extra debt payment that they have to worry about. Do they have the financial ability to take on a mortgage at that point in time? That's a big extra responsibility just to pay the tax man. So the insurance solution for this matter would be using a joint last to die whole life policy. So this one I projected out to be worth about $250,000 at age 90. What a coincidence. It does pay the tax bill of $240,000. Of course, it isn't free, so you do have to pay premiums every year. So the premiums in this one are about $5,400 a year. Well, great. I don't want to pay $5,400 a year. I'm going to pay more for why don't I just pay the tax bill? Well, it actually costs you for that $250,000 about $135,000 over that 25-year mark. So you've paid $104,000 less to get that money to pay the tax bill. So really, you paid a $240,000 tax bill with only $135,000. So nearly 50 cents on the dollar to pay that tax bill. Yes, the tax man is still going to get their money, but it's going to hurt less. Your kids aren't forced to sell the property just to keep it in the family. Now your family can create more memories for many more years to come for the grandkids, the great grandkids, and everybody else down the street. All right, so last one here is planning for charitable legacy. So Joe and Mary, they really want to ensure that they donate $500,000 to cancer care when they pass away. So that is an absolutely wonderful goal. They really want to make sure that happens, but they don't want to have to manage their investments along the way to make sure that, hey, we aren't spending too much. We're going to leave enough to pay that when we pass away. So what are the options? Obviously, one option would be, put $500,000 in the investment account, leave it there, be mindful, saying, no, we cannot spend this money. It has to sit there because that's our goal, to leave the money for the charity down the road. Absolutely fine, but again, it is a little bit more trying to make sure that that happens along the way. Or, of course, we can review their insurance options and look, how does the insurance solution fit into the mix for them? Well, let me show you. So if we do in this case, again, I did a joint last to die. So you'll probably hear me talking a lot about joint last to die, as if we're looking at a estate, there's generally no tax problem until the second person passes away. So we're looking at a policy that pays out only when the second person passes away, as that's when generally the money goes to the next generation, goes to charity, the taxes come due. So that's generally what we're planning for. So you're usually getting more insurance bang for your buck when we're looking at a joint last to die policy, provided that's the right fit for your situation. So in this case, we use a universal life policy, guaranteed death benefit $500,000. So check that one off the list. It meets their goal for the charitable giving. Annual premiums about $9,600 a year. Actual cost $240,000. So that $500,000, yes, it costs them $9,600 a year. But technically, it only costs them $240,000 to make sure that was given, which means that $500,000 that they had in the savings account, well, they just found $260,000, that extra cash, so they can just enjoy now in their retirement without worrying that goal is not going to happen. Sorry, Clinton, I see you popped in. I'll let you ask before I kind of dive into the rest of it here.
Sure. I appreciate that. Another cottage-related question, not quite the exact same thing, but takes us back to the prior topic. Talking about taxes on cottage, could a solution to save on taxes be to transfer the cottage in the kid's name before the owner passes away?
It can. It's not going to get rid of the tax bill. It's just determining when you're paying the tax bill. And again, once you hand over the keys and the title, you have zero control over what they do with it. So if they go and, again, have creditor issues, have, marital challenges, you could end up losing it. You could also lose complete control of the cottage. They could sell it the next day if they wanted to. And you don't get to do a darn thing about it, unfortunately, because you don't own it anymore. You have passed that along. So it certainly can be a good thing. It can be the right thing. Again, just make sure you're discussing all the pros and cons. But you're not going to get around paying the tax bill. It's just you pay it now versus paying it later is what it comes down to.
Yeah, so passing them on to the kids, you don't avoid the tax, you just pay it at the time you pass it on to the kids. So the tax doesn't disappear, you're just paying it whenever you make that transition.
You bet.
Okay, well, keep the questions coming. If you have more, we're happy to tackle them.
Excellent. All right, so wrapping up on this slide. So what does the donation do for your tax savings? So in the year that you pass away, the charitable donation can be used to offset 100% of your taxable income. So if you had $500,000 of taxable income, perhaps you have RSPs at the time you pass away or a family cottage by chance, this strategy can also help reduce taxes on that. So the charitable donation in this case of $500,000, offsetting $500,000 of income, ballpark save you about $252,000 in taxes for very simple math. So that's absolutely a great deal. And of course, the money goes to a charity, so it goes to a very worthy cause along the way. But wait a minute. So we just said that we paid $240,000 for the insurance, but we ended up saving $252,000. So did the insurance actually cost us money? Because it saved us more money than what it actually cost us. So sounds like a pretty good deal to me, if I'm being honest. And of course, many of this comes full circle, saying we need to have a financial plan in place. So I don't typically make all this up on the spot. We want to make sure that we do a deep dive, a thorough analysis of your financial situation to determine what is the right fit, what is the best solution for your situation, what are your goals, what are your objectives, so we can make sure that we're finding the right strategy to suit your needs and how we can help minimize tax for your estate, minimize tax in your retirement, or help you spend all your money if that's your goal. It's whatever is important to you, that's what we want to try to help you achieve. And that summarizes the end of my presentation, and we come to the questions. So if you haven't already asked a question, by all means, submit it on YouTube or Facebook, wherever you're watching, and we'll try to get to it for you.
Yeah, so if there are questions, please type them in the comment sections there. We're happy to tackle them. We'll stick around for a little while longer to tackle any questions that come up. And in the meantime, I'll let everyone know that we are going to be posting the replay. We are going to put it on YouTube, so there will be another opportunity to view it. You can look out for that link probably in the next day or two. We'll send that off. And as always, we've got lots of content on our Facebook page as well as on our website. We post content on the website on a regular basis. Kevin and I both create columns and have lots of additional details on there. And what you're seeing on the screen, the chat with Clinton and Kevin, if you're not comfortable posting in front of the whole group here, you can either email us directly, or you can always go to chatwithclintonandkevin.com. That's kind of the contact form on our website. So that'd be another way to get a hold of us. Yeah, so no additional questions coming in. Did you have any parting comments here, Kevin?
No, I think you've covered everything fairly well. Like you've mentioned, we will be replaying this or sending out the link so that you can catch it if you didn't catch all of it tonight or you'd like to watch it at a different time. Any questions you do have, by all means, chat with Clinton and Kevin. Easiest way to get in touch with us. We're more than happy to answer questions on anything in the wealth management sort of area. And then again, if not, we will go to Adam, our expert on all our wealth and estate planning needs, and he'll be able to help us out with whatever's needed going forward.
Perfect. Well, there are no more questions coming in. We're getting a few thank yous here. I'll pull one up here, Adam, so you can see thanks a million. It says for everyone, but Adam did the bulk of the heavy lifting here, so I'll pass that compliment along to Adam. And with that, I think we can cut it off there. If there are more questions afterwards, you can email us or use that chat with Clinton and Kevin. And we're having good feedback for these events, so likely we'll do more of them down the road. So everyone, thank you for tuning in. Take care. Stay safe.